Welcome to Ultimate Learning Hub. In today's session, we are going to look at earnings per share. Earnings per share. Earnings per share is covered under International Accounting Standard 33. International Accounting Standard 33. Now, what about earnings per share? The objective of earnings per share is to prescribe basically the principles of determining EPS amounts, EPS being earnings per share, to improve performance comparison between different entities in a given period or between different reporting periods. Basically, it's to enable us to know how much earnings the business makes for every share that is in the business within one accounting period or between two accounting periods. So it can help us to compare performance of company A to company B in terms of earnings per share, or performance of 1 year to the other year in one given company. So objective is basically to enhance comparison, in terms of earnings for every one share. Now, what do we cover under IAS 33? IAS 33 applies to entities whose ordinary shares are publicly traded. So basically, it applies to companies that are called PLCs, public limited companies. So long as a company trades its shares in the stock exchange market or in the securities exchange market, it applies to such companies. Publicly traded entities which present both parent and consolidated financial statements are only required to present EPS on consolidated figures. So if we have a group of companies, it's only a requirement of IAS 33 that only the group or the consolidated financial statements, we calculate their earnings per share. We don't need to calculate earnings per share for the individual companies. We only calculate the earnings per share of the group. Now, let's look at some few definitions in earnings per share. The first definition is earnings per share itself. What is earnings per share? It is the profit after tax minus any preference dividends, or in this case, amount of earnings for each outstanding stock. So in this case, when I talk about profit, which profit is this? Profit attributable to ordinary shareholders. Which profit is this? This is profit after tax and minusing the preference dividends, because ordinary shareholders are only paid after the preference shareholders have got their dividends. So it's the amount of earnings outstanding for, or amount of earnings for each outstanding stock. Outstanding stock is the ordinary shares. Now, what is ordinary shares, or what is common stock? It's an equity instrument that is subordinate to all other classes of equity instruments. So it's an equity. Remember, equity is the residual interest from the assets of the business after deducting liabilities. So it's an equity instrument that is subordinate. What do we mean by subordinate? Which means when it comes to paying dividends, they are paid last. They are considered last, but the advantages they have is if the business is performing well, if they are considered last, all that remains at last goes to ordinary shareholders. So what is an ordinary share? It's an equity instrument that is subordinate to all other classes of equity instruments. We also have potential ordinary share. A potential ordinary share is a financial instrument that may entitle its ordinary shareholders, that may entitle the owners to ordinary shares. In other words, if we have a loan, and that loan, we promise the issuer of the loan that if we promise the issuer of the loan that in that case, the issuer of the loan that the loan will be converted into ordinary shares in future, in that case, that loan becomes a potential ordinary share. So what is a potential ordinary share? In short, it is a financial instrument that is subordinate to all other financial instruments. Now, what are the examples of potential ordinary shares? The first example is what we call convertible debt. Convertible debt is just a loan that will be converted into ordinary shares in future. We also have convertible preference shares that will be converted in future to ordinary shares. We have share warrants, share options, share rights. Now, share warrants is just a guarantee to individuals or to institutions that they will be given shares in future. Share options, you give somebody the option to acquire shares, the right to acquire shares, but not obligation to acquire shares in future. So you give them an option, the right, but they are not obligated to acquire shares in future. Share rights, when you issue new shares to existing shareholders in proportion to their current shares at a price below the market price, but above the nominal price. Employee stock purchase plans, in employee stock purchase plans, in this case, let me go back to share rights. Share rights is just giving somebody the right to have shares in future. Employee stock purchase plans, this is where employees are encouraged to align. If we want to encourage the business to have what we call goal congruence, that is the objective of the employees is in line with the objective of the business, we normally introduce what we call employee stock purchase plans, where employees are given options to buy shares in the company where they work. And finally, contractual right to purchase shares. So which means we sign an agreement with you that in future you will buy shares in the company. So what is a potential ordinary share? It's a financial instrument that will be converted in future to ordinary shares. A financial instrument that will be converted in future to ordinary shares. We also have a term called dilution. From the English perspective, dilution is to reduce the concentration of something. So when we talk of diluted EPS, if, for example, the EPS was 100, to dilute it, 100 per share, to dilute it is to bring it to a figure below 100 per share. So to dilute it is to bring it to a figure below 100. But if it was a loss per share, to dilute it is to increase the amount above 100 in case of a loss. So what is dilution? Dilution is a reduction in earnings per share or an increase in loss per share resulting from the assumption that convertible instruments are converted, options or warrants are exercised, or new shares are issued upon satisfaction of certain conditions. So basically, it's a reduction in EPS. The EPS must come down, but if it's a loss, it must increase. And it must result from convertible instruments converted. We have already given examples of potential ordinary shares. So if convertible instruments are converted, options or warrants are exercised, and number 3, ordinary shares are issued upon satisfaction of specific conditions. In that case, it's dilution. Now, the opposite of dilution is anti-dilution. Now, in anti-dilution, we just reverse the terminologies used in dilution. For example, in dilution, it was a reduction in earnings per share. Now we'll call anti-dilution an increase in earnings per share. In dilution, it was an increase in loss per share. So we will call anti-dilution decrease in loss per share. The rest remains the same, resulting from the assumption that convertible instruments are converted, options or warrants are exercised, or new shares are issued upon satisfaction of specific or certain conditions. Now, when we look at the scope of IAS 33, in IAS 33, we want to divide it into 2. Number 1, we'll be looking at what is called basic EPS, and number 2, we'll be looking at diluted EPS. Now, a basic EPS does not account for potential ordinary shares. Potential ordinary shares are not accounted for under basic EPS. On the other hand, under diluted EPS, potential ordinary shares are accounted for. Now, let's move to this first part. So we want to focus on a basic earnings per share, which does not account for potential ordinary shares. Now, how do we calculate the basic earnings per share? Basic earnings per share is profit attributable to ordinary shareholders. You divide by weighted average number of ordinary shares. Profit attributable to ordinary shareholders holders, you divide it by weighted average number of ordinary shares. Now, profit attributable to ordinary shareholders, this is basically the profit after tax minusing the preference dividends if there is. Now, weighted average number of shares is only used when new shares are introduced during the year. If we introduce new shares during the year, we cannot use the shares that we had at the beginning of the year. We must calculate an average, the weighted average of these shares, so that we bring in the new shares and we add them to the old shares that were there. So in short, basic EPS is profit attributable to ordinary shareholders divided by weighted average number of ordinary shares. Now, when we are accounting for basic EPS, this calculation is done under the following conditions. So when you want to find the basic EPS, there are some factors that you must look at. Number one, you must check whether shares were issued at full market price. Number two, what we call bonus issue of shares. Sometimes it's always called capitalized issue or a scrip issue. And number three, we look at rights issue of shares. So when we want to look at what affects basic EPS, number one, shares issued at full market price. Number two, bonus issue of shares. And number three, rights issue of shares. So suppose we start with number one, issue of shares at full market price. Now, when we issue shares at full market price, it means the new shares are being given at the market price at which any other person can buy such shares. When we issue shares at full market price, it means cash will be introduced to the business. So when we issue shares, we are also introducing cash into the business. So earnings should be apportioned over the weighted average equity share capital, and that is taking account of the date any new shares are issued during the year. So we must also do the proration depending on the dates that new shares were issued. If you issue shares mid-year, that is 6/12. We must prorate the issues. So we have an example that we'll try to solve to enable us explain issue of shares at full market price to enable us to calculate the earnings per share. So we have a question with us. A company issued 200,000 shares at full market price of $3 on 1st July. So 1st July is the middle of the year. 1st July is the middle of the year. So there are 6 months before the new issue of shares, and there are 6 months after the issue of the shares. So note that it was issued in 2008. Now you have been given some information, relevant information for the year 2008, in the year that new shares were issued. And also we have the previous year. In the previous year, there were no new issue of shares. So the number of shares that are there, we don't need to calculate weighted average number of shares in 2007 because new shares were only issued during the year 2008. So it is only in the year 2008 that we'll be calculating weighted average number of shares. So you have been told the profit attributable to ordinary shares at the end of the year, 31st December, is 550, and we have 460 for 2007. And the number of ordinary shares by the end of the year, not at the beginning, at the end of the year 2008 is 1 million, and at the end of 2007 is 800,000. What does that mean? 800,000, if it's the number of shares at the end of 2007, that will be the number of shares at the beginning of 2008. And then we added 200 new shares on 1st July. So at the beginning of 2008, we had 800,000 shares, and then we added 200,000 shares, and that is what will give us 1 million number of shares at the end of the year 2008. So the question is asking us, calculate the EPS for each of the years. Calculate the EPS for each of the years. So in order to enable us calculate the EPS for each of the years, we'll be looking at this question, and we go to Excel to enable us solve it understandably. Now, in order to calculate EPS, we have said EPS, for example, if I want to get the EPS in 2008, that is what I'll start with. EPS in the year 2008, the formula that we have learned so far when calculating EPS is profit attributable to ordinary shareholders you divide by weighted average number of ordinary shares. So you take the profit attributable to ordinary shares, you divide by the weighted average number of ordinary shares. So we need to list our profits. What is the profit in 2008? And we saw that the profit in 2008 was for 550. So our profit in 2008 is 550,000. We also need to list what is the profit in 2007. And we have found that our profit in the year 2007 is 460,000. 460,000. And then after we have listed the profit, we need to look for the denominator, which in 2008, we will have to calculate the weighted average number of ordinary shares. Weighted average number of ordinary shares in the year 2008. Weighted average number of ordinary shares in the year 2008. Weighted average number of ordinary shares in the year 2008. So in this, we'll have to calculate it. But the number of ordinary shares in 2007, number of ordinary shares in 2007 is equals to 800,000. 800. But 2008 is when we need to calculate weighted because there were new shares issued. Now, how do we go about this in weighted average number of shares in 2008? We will prorate the figures. So we'll write the first date of the year, 2008. 2008. We look at how many shares we had. Now, in this case, we are looking at 1st January 2008 to 30th June 2008. Why 30th June? The date just before new shares were issued. So just before new shares were issued, we had 800,000 shares. So between 1st January 2008 and 30th June 2008, we had 800,000 shares. And that is a period of 6 months. So we will prorate it by multiplying it by 6/12 because those are 6 months. So what does that give us? It gives us a value of 800,000 times 6 divided by 12. So it gives us a value of 400,000. Now let's look at what happened on 1st July 2008. So on 1st July 2008, we added new shares. There was add new shares. So there were new shares added on that particular date. So on that particular date, we added 200,000 new shares. So these are the 200,000 new shares at that date. So after that date, just after that date, in other words, from 1st July 2008, not 7, 2008 to the December, to 31st December 2008, we now had a total of 800,000 plus the new shares that were issued at the beginning of July. So we had 1 million shares. And that period, again, it shows that the period is for 6 months. 6 months, that is from July to December. So what is the average number of shares? It is times 6/12. So we must get the weights by prorating depending on the number of months we had shares. So what is the total? The total here is 400,000 plus 500,000. And that is what gives us, what have I done? So we have 400,000 plus 500,000. We have 900,000. And that gives us the weighted average number of shares. The weighted average number of shares in 2008. So we have all the data that now we need to answer the question. So once we have all the data, we now need to calculate what is the basic EPS. Basic EPS in 2008. So the basic EPS in 2008, we have said it is profit attributable to ordinary shareholders divided by weighted average number of shares. So the profit attributable to ordinary shareholders in 2008 was 550. and the weighted average number of shares was 900,000. So when you divide the two, we get, so 550 divided by 900,000. So we get 0.61, and it will be dollars per share. We will have dollars per share. So that's how we calculate the basic EPS when shares are issued at full market price. But we also have the basic, we were asked for 2 years because we must compare the data. So basic EPS for the year 2007. So what is our basic EPS for the year 2007? We pick the profit for the year 2007, and in 2007, there were no new issue of shares. So we just pick the number of shares that we had during that year. It is 800,000. And that will therefore give us, the basic EPS will be 460 divided by 800. It will give us 1, but if I round it off to see if, so it gives us $0.58 per share. So that's how we calculate the basic EPS per share. So that's the first example on how to calculate the basic EPS. So that's how we find the basic EPS in such a question. So the first way, the first factor that affects basic EPS is issue of new shares at full market price. Issue of new shares at full market price. Number two, the second factor that affects basic EPS is when we issue bonus shares. Issue of bonus shares. So issue of bonus share, remember a bonus issue is issue of new shares to the current shareholders in proportion to their current shares at a price for free. Issue of new shares to the current shareholders in proportion to their current shares for free. So in a bonus issue, it does not provide, it was because it was issued for free, it does not provide additional resources to the issuer. There is no cash that is received. And this means that the shareholders owns the same proportion of the business before and after the issue, because we were issuing shares in proportion to the current shares. But the key point, the take-home point, bonus is issue of shares for free. So there is no new cash that we expect. So in the calculation of EPS, the bonus shares are deemed to have been issued at the start of the year, and comparative figures are restated to allow proportional increase in capital. Now, in a bonus issue, we normally introduce what we call adjusting factor. So how do we calculate the adjusting factor? Because we issued shares in a certain ratio, new shares in a certain proportion. So for example, if we issued 1 new share for every 2 shares, 1 new share for every 2 existing shares, there is 1 and there is the 2. So 2, we take it to be X, and 1, we take it to be Y. So there is an adjusting factor that we introduce in the current year, the year, because when we are calculating EPS, we calculate of 2 periods to compare. So there is the current year and there is the previous year that we compare current year to. So for the current year, we introduce an adjusting factor, which is X plus Y divided by X. X being the current ratio of shares, Y being the new ratio of shares, X being the current ratio of shares, Y being the new ratio of shares. Now, also in the previous, to make the financial statements comparable, we must also get the adjusting factor in the previous year. Now, how do we get the adjusting factor in the previous year? By having X divided by X plus Y, where X is the current ratio of shares and Y is the new ratio of shares. Y is the new ratio of shares. So let's also have a look at an example. So we are continuing. A company makes a bonus issue of 1 new share for every 5 existing shares held on 1st July 2008. So they issue 1 new share for every 5 existing shares held on 1st July 2008. So 1 for every 5. So 5 will be the X and Y, and the Y will be 1 because it's a ratio of 1 for every 5. And they were issued on 1st July 2008. So that means, again, in 2007, there was no issue. The data which we have profit at the end of the year 2007 is 460,000, and the number of shares at the end of the year 2007 is 1 million. So if we issue one new share for every 5, you will take the 1 million times 1 divided by 5. So that will mean that we would have introduced 200,000 bonus shares. So when we take the 200,000 and we add it to the 1 million, that is what gives us this 1.2 million. So let's look at the required. Calculate the EPS. Calculate the EPS in 2008 accounts and comparative what? Figure and comparative figures. And again, we must go to Excel sheet and we solve this. So we are looking at bonus. The same question is there. So a company makes a bonus issue of 1 new share for every 5. So for every 5. So here we are looking at solution. So it's our solution on bonus issue of shares. Bonus issue of share. So what is familiar, we must start, a company makes a bonus issue of 1 new share for every 5 existing share. So we must get what is called adjusting factor. Now, adjusting factor for the current year, which is 2008, we said it is X plus, X plus Y divided by X. Divided by X. X plus Y divided by X. So that is new 1 for every 5. So we have 5 plus 1 divided by 5. So that gives you an adjusting factor, which is equivalent to 5 plus 1. So that gives you 6 over 5. So the adjusting factor is 6 over 5 of the current year. That is the adjusting factor of the current year. So we must also get, just like that, we must also get adjusting factor of the previous year. Previous year is 2007. Adjusting factor of the previous year. So adjusting factor of the previous year is X divided by X plus Y. So that will be equals to 5 is the X, 5 plus 1 is, so that will give us, it will give us the 5, and here we'll have 5 plus 1. So it gives you 6. It gives you 6. And then next we get profit. Now from the question, our profit is 550,000. You divide by, profit, and that is profit in 2008, profit in 2008. Let me be very clear in everything. So, and then we can get also profit in 2007. Profit in 2007. And our profit in 2007 is 460,000. 460,000. And then we can have number of shares in 2007. Number of shares in 2007. So what are our number of shares in 2007? 1 million. So we have 1 million. So our number of shares is 1 million shares. And then finally, just like number of shares, because there was no new issue of share, in 2008, there was a new issue of share. So we will calculate the weighted average number of shares in 2008. Why do we calculate the weighted average once more? We calculate the weighted average because there were bonus shares introduced during the year. There were bonus shares introduced during the year. So let's list our dates as usual. 1st January 2008 to 30th June 2008. We had, remember that is the date before the bonus issue. We had 1 million shares. So we had 1 million shares. So we had 1 million shares. And this is a duration of, so times 6/12. That is the duration. And you multiply by the adjusting factor. So times the adjusting factor of 2006 is, of the current year, is 6/5. 6/5. So what will that give you? 1 million times 6/12, again times 6/5, being the adjusting factor in the current period. So that gives you 600,000 shares. And then on 1st July 2008, we introduced new shares. So add the new bonus shares. Add the new shares. So what were our new shares? Our new shares in that time was, remember, it was 1 million, the current shares, times 1 for every 5. Times 1 for every 5. So the current number of shares, let me just have it as 1 million shares times 1. So that gives us 200,000. So what is the total number of shares after the bonus issue of 200,000 shares? We have a total of 1.2 million. Now that total runs from 1st July 2008 and it goes until 31st December 2008. And how many months are those? Those are again 6/12 months. Now, after the issue, we don't multiply by the adjusting factor. So our answer becomes, we don't multiply by the adjusting factor. 1.2 million times 6 divided by 12. So that gives you 600,000. So what is our weighted average number of shares in 2008? It is 600,000 plus 600,000, and it gives us 1.2 million. This will enable us, therefore, to calculate the basic EPS. The basic EPS in 2008 will be equals to the profit of 2008 divided by the number of shares in 2008, the weighted average number of shares in 2008, and that will give us the profit divided by the number of shares in 2008, which gives us $0.446 per share. And then we have basic EPS in 2007. In 2007, the profit in 2007 was 460, and the number of shares, because there were no new shares, is 1 million. So our basic EPS in 2007 is 460. 460 divided by, to give you 0 point something, let's round off. So 0.4. What is not happening? 460 divided by 1 million. Is there something not right? This 0.46. Okay, here is where I went wrong. I was supposed to be dividing that. Divide by that. Let me just redo them. This is 550 divided by 1.2, 0.46. Okay, Okay, I did not multiply by the adjusting factor. So the adjusting factor in the previous year, it was 5/6. Sorry for that. 5/6. So that gives you, 460 divided by 1 million times 5 divided by 6. So it gives you 0.3, maybe to 2 decimal places, dollars per share. So you realize that in the year 2008, performance was better than the year 2007 because we had a higher earnings per share. In 2008, we had earnings per share of 0.46, and the earnings per share in 2000, in the previous year, it was 0.38, which is the less than the current year. That is how we account for bonus issue of share. Finally, we want to go to rights issue of share as a factor that affects rights issue, as a factor that affects basic EPS. So what is a rights issue of shares? A rights issue of shares is issue of new shares to the current shareholders in proportion to their current shares at a price below the market price, but above the nominal price. At a price below the market price, but above the nominal price. Remember, we said there are 3 factors that affect basic EPS. Number 1, issue of new shares at full market price. Number 2, bonus issue of shares. And now we are in number 3, rights issue of shares. Now, in a rights issue of shares, it presents special problems. They contribute additional resources. So in a rights issue of shares, there is new resources gained because we are issuing it at a price below the market price, even though it is above the nominal price, but we are still receiving something. And when we issue the rights, normally it's priced below the market price. And therefore, they combine the characteristics of issue of shares at full market price and also bonus issue of shares because it's at a price below the market price. Now, just like in the bonus issue, the adjusting factor in the current year was X plus Y divided by X. And in the previous year, it was X divided by X plus Y. Now, adjusting factor in a rights issue is different. Adjusting factor will be, because we are issuing at a certain price, we will not use ratio. We will use market price of the shares divided by what we call TAP. TAP stands for theoretical X-right price. So theoretical X-right price. So the adjusting factor in the current, so what is the theoretical X-right price? It is the average price of the shares after the rights issue. You know, when we issue a rights, we are issuing it at a price below the market price. Therefore, the average price of the shares will reduce because new shares were introduced with a lower share price. Now, this average price of the shares after the rights issue is what is known as theoretical X-right price. We normally abbreviate this as TAP. Now, to get the adjusting factor in the current year, it is MPS, you divide by TAP. And adjusting factor in the previous year is TAP divided by MPS. Now, how do we calculate the TAP? How do we calculate the theoretical X-right price? Remember, we can issue 1 new share for every 2. We can issue 1 new share for every 2 shares. So here, the current will be 2, the new ratio will be 1. If we issue 1 new share for every 2 shares held, the current will be 2, the new will be 1. And then you multiply the current times the market price and the new times the price at which it was issued to give you a certain value for the current and a certain value for the new. And then you get the total ratio, which is 2 plus 1 to give you the total ratio, and also you get the total value. Now, when you have the total value, you divide by total ratio, that is what gives you the TAP. That is what gives you the TAP. So let's have our final example, which is in rights issue. A company issued 1 new share for every 2 existing shares held by way of a rights at 1.50 per share on 1st July 2008. Pre-issue market price was $3 per share. And then you have been given the relevant information for 2008 and also for the 2007. I'm repeating, a company issued one new share for every 2 existing shares held by way of a rights at $1.5 per share on 1st July 2008. Pre-issue market price was $3 per share. Relevant information for 2008 and 2000. So there was one new share for every 2 shares. So let's go to Excel and solve the question. Now, in our Excel solution, so it is an example on a rights issue of share. So when we are trying to solve these, we will start by solution. So our solution is on rights issue of shares. Is on rights issue of shares. So we'll start with adjusting factor, which we still don't know until we calculate. Adjusting factor for the current year is 2008. We will calculate it. We have said it is MPS. We divide by theoretical X right price. That is for adjusting factor for 2008. We will also find the adjusting factor for 2007. Adjusting factor for 2007. And it will be TAP divided by MPS. TAP divided by MPS. TAP divided by MPS. So we still, okay, MPS we know from the equation. We know that the MPS is 3. MPS is 3, but what is missing is the TAP. What is missing is the TAP. So we will need to calculate the TAP. So how do we calculate the TAP? So TAP in full is theoretical X right price. So that is our TAP. That is our TAP. Theoretical X right price. Now, how do we calculate our TAP? We said there was the current and there was the new, and then there is the total. So what was our current? So I'm skipping some space. There is a current, there is a new, and there is a total. There is a total. So we need to, what is the current? A company issued one new share for every 2 existing shares. So there is 2 current, and they were issuing one new share for every 2. So what is the market price? Market price is 3, and the issue price held by way of a rights of 1.5. So the issue price here was 1.5, a price of 1.5. So that will give us the values is 2 times 3 to give us the value of the current. And here we have 1 times 1.5 to give us a value of that. So remember, this is the value. This is the ratio, and this is the price per share. So what is the total value? The total value is 7.5, and the total ratio is 3. So in order to get the TAP will be equals to total value divided by total ratio. Total value divided by total ratio. So that will be 7.5 divided by 3, which will give you 7.5 divided by 3. It will give you 2.5. So it will give you 2.5. And then after that, we come and list the profits. So we have the theoretical exit price. What is the profit? What is the profit for the year 2008? And what is the profit for the year 2007? So we'll have to get the profit in each case. So the profit in 2008 is 550 and 2007 is 460. 550 and 460. So in this case, what about the number of shares? Number of shares in 2007. Remember, there were no new shares introduced in 2007. So we don't need to calculate the weighted average. We just pick the 800,000. So because there were new, you only calculate weighted average if there are new shares introduced. So we can now therefore get the weighted average number of shares in 2008, because that is when new shares were issued. Weighted average number of shares in 2008. So the dates are the same. So as to enable me save time, I can come and just pick these dates. So I've just posted that because the dates of the issue were the same. These shares were issued on 1st July 2008. So how many shares did we have between 1st January and June 2008, just before the new issue of shares? So before the new issue of shares, we had the number of shares at the end of that year plus the new number of shares. What was the ratio? 1 new share for every 2. 1 new share for every 2. So we will take the 800,000, we'll multiply by 1, we'll divide by 2 to get the new number of shares. So the total number of shares will be 800 plus 400,000. Now, between 1st January 2008 and 30th June 2008, we had a total of 6 months. 6/12. And the adjusting factor, there was also an adjusting factor. Okay, in 2008, what was the adjusting factor? 2.5. 2.5. Okay, it was 2 point. TAP was 2.5. So TAP is 2.5. So that is what I can bring here. So TAP in 2008 is 3 divided by 2.5. 3 divided by 2.5. So we have this 3 divided by 2.5. So times 3 divided by 2.5. And then we get our answer. And here we have times, again, 6 months over 12. But we said we don't multiply by the adjusting factor. Adjusting factor is only applied just before the issue. So we have 800,000 times 6/12 times 3 divided by 2.5. What do we get? We get 480,000. And for after July, after the issue of the rights, we have 1.2 times 6/12. So that gives you 600,000. So what is our total? 480,000 plus 600,000. It gives you weighted average number of shares of 1.8 million. Finally, we calculate the basic EPS in 2008, which is the profit in 2008 is 550 divided by the weighted average number of shares. Okay, let me just write the amounts. Profit in 2008 was 550 and the number of shares was 1 million. So we take 550 divided by 1 million. It gives us $0.5 per share. And here, next we have basic EPS. Basic EPS in 2007. This is our final calculation. So our profit in 2007 is 460, and our number of shares in 2007 is 800. And then you multiply by the adjusting factor of the previous year, 2.5 divided by 3. So 2.5 divided by 3. And that will give you 460 divided by 800 times 2.5 divided by 3. So it gives you 0.48 dollars per share. And that brings us to the end of basic EPS. That brings us to the end of basic EPS. In summary, what have we looked at in basic EPS? We have said in basic EPS, the formula is weighted average profit attributable to ordinary shares divided by the weighted average number of shares, divided by weighted average number of shares. And then we have said basic EPS is affected by number 1, issue of shares at full market price, number 2, bonus issue of shares, and number 3, rights issue of shares. Remember, in a bonus issue of shares, there is an adjusting factor in the current year of X plus Y divided by X, and in the previous year, X divided by X plus Y. The adjusting factor in a rights issue is MPS over TAP, theoretical X-right price, in the current year, and in the previous year, it is TAP over MPS. And that brings us to the end of basic EPS. In the next session, we will look at diluted EPS. Diluted EPS. Remember, we explained dilution as a decrease in loss in earnings per share or an increase in loss per share resulting from the assumption that convertible instruments are converted, options or warrants are exercised, or new shares are issued upon satisfaction of certain conditions. So remember to follow the link so that you join the next session, which will be looking at diluted EP.